Ladies and gentlemen, good day and welcome to the Capital Small Finance Bank Limited Q1FY27 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sarvajit Samra from Capital Small Finance Bank Limited for opening remarks. Thank you, and over to you, sir.
Thank you, Avirat. Good morning, everyone, and thank you for joining Capital Small Finance Bank Limited's Q1 Financial Year 27 earnings call. Our financial results and the investor presentation have been filed with the stock exchanges and are available in the public domain. We trust you have had an opportunity to review the same. Joining me today are Mr. Munish Jain, Executive Director, Aseem Mahajan, Chief Financial Officer, Raghav Agarwal, Chief Credit Officer, Branch Banking, Sahil Vijay, Chief Treasury Officer and Investor Relations Lead, Bharti Babuta from our Investor Relations team, and along with our IR advisors, SGA. I will begin by sharing our perspective on the operating and macroeconomic backdrop during the Q1 Financial Year 27, after which we will discuss the bank's performance and outlook in greater detail. The quarter gone by witnessed a gradually improving operating environment for the banking sector. While global uncertainties and the geopolitical developments continue to influence commodity pricing, inflation expectations, and financial markets, the Indian economy continues to demonstrate remarkable resilience and remains one of the fastest growing major economies globally. Growth continues to be supported by healthy domestic consumption, resilient rural demand, steady government capital expenditure, and improving investment activity. Against a backdrop of moderating global growth, India's structural growth drivers continue to position the country favorable for sustained economic expansion. From a banking sector perspective, system credit growth remains healthy across retail, MSME, and agriculture segments, while the deposit environment, though competitive, has started showing signs of normalization. The repricing of high-cost deposits across the industry is gradually easing funding cost pressures and creating a more supportive environment for margin expansion. At the same time, the government's decision to maintain interest rates on small savings schemes has helped preserve the competitive positioning of bank deposits and contributing to a great stability within the liability landscape. Against this backdrop, Capital Small Finance Bank remains well positioned to capitalize on the opportunities ahead. Our franchise continues to be anchored on three key strengths: a secured and granular loan portfolio, a stable and retail-focused deposit franchise, and deep relations across the semi-urban and rural markets that we serve. As we have outlined earlier, Financial Year 27 remains a year of profitable growth, operating leverage, and improving returns. The benefits of deposit repricing have started flowing through, while a strong capital adequacy and liquidity position provide us with ample headroom to support growth across all our core lending segments. Our strategic priorities remain unchanged. We continue to focus on growing our secured loan portfolio led by MSME, mortgage, and agriculture segments, deepening our presence across contiguous geographies, strengthening our retail liability franchise. Having completed a decade as India's first small finance bank and over 26 years as banking institution, we believe the opportunities ahead remain significantly higher than those behind us. We remain committed to create long-term value for all stakeholders through responsible banking, customer-centric innovation, and sustainable financial inclusion. With that, let me now take you through bank's performance for the first quarter of Financial Year 27. Gross advances increased to 9,074 crore, registering 22% year-on-year growth, led by traction across MSME and other business loans. Total deposit for the quarter stood at 10,596 crore, growing 16% year-on-year, with CASA improving to 36.7%, earlier from 34.7% in March 2026. Disbursements remained healthy at 1,009 crore during the quarter. Asset quality remained stable with GNPA at 4.47% and NNPA at 1.14%. Net interest margin stood at 4.2%, while profit after tax for the quarter at 41 crore. Going forward, we remain focused on deepening customer engagement, improving productivity across our franchise, expanding selectively in semi-urban and rural markets, and preserving the strong asset quality and operating efficiency. With that, I would now like to hand it over to Mr. Manish Jain, who will take you through the detailed financial and operational performance. Thank you.
Thank you, Mr. Shamra, and a warm welcome to everyone on the call. I will now walk you through the key business and financial highlights for the quarter ended June 2026. As of June 30th, 2026, our gross advances stood at 9,074 crores, reflecting sustained momentum in credit growth. On a year-on-year basis, advances grew by 22%, while sequential growth stood at 4.5%, underscoring both consistent execution and healthy demand across our core lending segments. Disbursement momentum remained strong. Fresh disbursement during the quarter stood at 1,009 crores, representing 17% year-on-year growth, reflecting sustained demand across key segments and the effectiveness of our distribution and underwriting capabilities. Our loan book remained firmly anchored in secured lending. As of quarter end, 97.4% of the portfolio was secured, aligned with our retail-led and risk-calibrated approach. Importantly, 88.82% of our non-corporate book is backed by immovable property or secured against bank FDR, reinforcing our focus on maintaining a high-quality, well-collateralized and risk-mitigated portfolio. The average ticket size stood at 19.04 lakhs against 16.6 lakhs in Q1FY27, reflecting the granular nature of our lending portfolio. Our portfolio continued to remain well diversified, and business loan segment is presently the largest segment in the portfolio, which increased to 27% of the book against 22% a year back. The mortgage segment remains stable at 25% of the total book against around 26% a year back. Agriculture segment presently constituting around 27% against a 30% a year back, and corporate exposure remains stable at 14%, reflecting a calibrated approach into well-rated corporate borrowers consistent with our disciplined growth framework. The disbursement during the quarter continued to remain diversified, with the business loan accounts for 35% of the incremental disbursement, mortgage constituting 21%, agriculture around 15%, while 20% towards NBFCs and large corporates, with the balance comprising consumption and other loans. Encouragingly, growth outside Punjab continued to outpace the overall portfolio. Advances in non-Punjab geography recorded over 30% year-on-year growth, highlighted the increasingly contribution and scalability of our newer markets and strengthening relevance of our franchise beyond our core geographies. Asset quality showing consistent improvement during the quarter, with gross NPA improved to 2.47%, improved by 28 basis points and by 7 basis points on year-on-year and quarter-on-quarter basis. Net NPA has also improved significantly and now stood at 1.14% compared to 1.24% in the previous quarter and 1.39% in the corresponding period last year. These metrics reflect prudent underwriting standards, stable portfolio performance, and consistent recovery efforts. Credit cost for the quarter was 0.31%, largely in line with the last year. During the quarter, PCR has increased to 54.5% against 51.9% in Q4 FY26 and 50.17% in Q1 FY26. Early stress indicators also improved, with SMA and SMA2 accounts at 4.78% of the advances, down from 5.47% a year ago, supported by proactive collections and early delinquency management. On the liability side, our total deposits stood at 10,596 crores and continue to remain primary source of our funding and constituting around 95% of the total outside liabilities. Deposit registered 16% year-on-year growth and 6% quarter-on-quarter growth, which is commensurating with our advance growth. The deposit continued to be retail-centric, with retail deposit share remained above 90%, with rollover ratio of 90% plus. The same provided stability to our funding profile. The CASA improved to 36.7% from 34.7% in the previous quarter, underscoring the continued trust of our customer and the strength of our retail deposit franchise. The cost of deposit has shown improvement during the quarter, consequent to benefit of deposit repricing on their maturities. The cost of deposit for the quarter stood at 5.6% against 5.8% a quarter back. The average credit to deposit ratio remained healthy with 83% in Q1FY27 compared to 80.9% in Q1FY26. Our balance sheet remained well capitalized and liquid. The capital adequacy ratio stood at 21.6%, providing sufficient headroom to support the future growth. The average liquidity coverage ratio for the quarter was at 184.18%, reaffirming our conservative approach to liquidity and risk management. As of June 26, our branch network expanded to 116 branches across 5 states and 2 union territories, strengthening our presence in rural and semi-urban markets, which remain the key drivers of the long-term growth. Turning to the profitability, net interest income or net interest margin has improved to 4.21% against 4.06% in the previous quarter and 4.06% a year ago. The same is supported by a decline in the deposit cost on repricing coupled with acceleration in the CD ratio. Net interest income grew by 22% on year-on-year basis and stood at 134 crores against 110 crores in Q1 FY26. Non-interest income remained stable at 0.82% of the average total assets and grew by 13% on year-on-year basis. Operating efficiency remained broadly stable with cost to income ratio at 59.5% compared to 60.6% last year the same quarter. Operating margin remains strong at 2.04% against 1.94% a year ago, with pre-POP, that is a pre-provision operating profit, increased by 23.1% year-on-year to 64.7 crore against 52.5 crores in Q1 FY26. Profit after tax increased by 29% year-on-year to 41.3 crore against 32 crores in Q1 FY26, with return on assets stood at 1.3 against 1.18% in Q1 FY26. In summary, we remain confident in our strategy and execution and committed for creating long-term value for our stakeholders while contributing meaningfully to the Indian growth journey. As we look forward, the momentum of the first quarter marks an important step towards Vision 2029 and making us well positioned to achieve the target FY29 loan book of 16,000 crore plus and 22% growth in FY27. We expect NIM to stabilize at the current levels for the FY27 and start further expanding, supported by improving CD ratio in the coming years. During Q1 FY27, the benefit of deposit repricing has shown the results, and cost of deposit during the quarter has declined to 5.6% against 5.8% in Q4 FY26. We expect further ROTA expansion and targeting to make it towards 1.4% in FY27 and 1.6% plus by FY29 and ROE expansion to 15% plus by FY29. Our continued focus on secured, granular and profitable growth, supported by strong asset quality, robust capital levels and disciplined risk management, positioned as well to deliver sustainable performance in the coming periods. The book value continued to show improving trajectory and stood at 327 per share with EPS on annualized basis of 36.4. With that, I would now request the operator to open the floor for question and answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Pritesh Pam from DAM Capital Advisors. Please go ahead.
Hi, sir. Good morning. Congrats, sir, on a good outlook and numbers. Sir, just a few things. One is on the MSME side, we've been seeing a strong growth. Can you give me the split for MSME between Haryana and Punjab? How has that been growing?
Pritesh, if I talk about the MSME, first I give you some color about what we are doing in MSME. As like any other business, we are targeting the middle income segment MSME, which is collateralized by immovable property. So we are a purely collateralized lender. The average ticket size of this particular portfolio is 28 lakh rupees. So the growth of this particular portfolio on a quarter-on-quarter is 11 and year-on-year is 49%. The growth is well split between Punjab and Haryana. So the growth between the MSME growth within the state of Punjab versus the out of state of Punjab are around nearer to each other. So we are growing at a similar level MSME both in Punjab and Haryana. So while I'm not having a handy about the MSME portfolio between Punjab and out of Punjab or Punjab and Haryana, but overall advances out of Punjab now is 25%. Which was 24% a quarter back and around 21% a year back. So we are seeing a continuous traction between Punjab and out of Punjab. And the portfolio in MSME is primarily a domestic consumption-led portfolio to that particular segment of the customer who are typically more dependent upon the indigenous and the domestic consumptions.
Right. Okay. Second question was on the provision coverage ratio. The provision itself, we've seen a slightly higher provision this quarter. Generally, we've seen that we maintain the provision coverage ratio, but seems to be from last few quarters we have been increasing the coverage ratio. Any strategy on that? I mean, what are we thinking about it?
Pritesh, our medium-term target is to bring the net NPA towards 1% level. So we were seeing some good profits or the decent profits are there. So we've taken the opportunity to increase the PCR so that we can move towards the net NPA in that direction. So now we have seen a majority of that action has been done. Now our net NPA has come towards 1.14%, which was we are able to improve it significantly against 1.39% a year back and 1.24% a quarter back. So the PCR is directing towards our medium-term vision, where we have mentioned our 2029 vision to make the net NPA towards below 1% level. So that is where this particular thing is happening. And now I see a majority of the action has been taken care now.
So we'll have a stable PCR from here on is what we're trying to mention.
Yes, we are anticipating a stable PCR going forward. And with that stable PCR, we can now achieve over 1% net NPA target in a medium-term basis.
Sure. So the next question is related to this itself. What are we targeting as a ROA, given that our ROA has been stable at about 1.3 for a few quarters on a reported basis. So because this provision has been slightly higher and that has been to a certain extent restricting the overall ROA.
So we seeing a ROA expansion both for the current fiscal and the coming period. Current fiscal FY27, we are targeting to take it towards 1.4. I will say the range of 1.35 to 1.4 is the range of ROA, which we look forward. And we look forward of a further expansion of the ROA by FY29, where we want to take it towards 1.6% plus levels. So we are fully committed towards the ROA expansion. And even if you look into the current quarter, the ROA has been expanded, which was 1.18 last year Q1 towards 1.3. And more importantly, PPOP margin, that's the pre-operating profit margin, has improved from 1.94% to 2.04% during the Q1 FY26. For 27 versus 26.
Sure, sir. And last question was, how much is the headroom left in cost of deposit to be repriced? Anything left there for us?
There is some cost of deposit is due for repricing, but that the price delta between the contracted rate versus the present prevailing rate is not that significant. So our cost of deposit, I think the majority action has been done. It's just, I will say some portion is still left, but that is not very material. So material portion, which we already talked, was in Q4 last year and Q1 current year, which has been taken care. So now we will see the NIM to be stabilized in the current year towards the present level of 4.2-ish level, and then look forward for further expansion of the same in the coming period with our CD ratio expansion. So with now the cost of deposit has reached to the level where we are intending to bring it around 5.6% level. So we see the repricing benefit are primarily taken care, but still there is some repricing benefit still left, which is due on Q2FY27.
Sure, sir. Thank you so much and all the best, sir.
Thank you, Pritesh.
Thank you. The next question is from the line of Aditya Mundra from My Temple Capital. Please go ahead.
Hello, sir. Good morning, sir. Am I audible?
Good morning, Aditya ji. Yeah, you are fully audible.
Yes. Sir, couple of questions. Sir, so our NIM, you mentioned that it will continue to remain stable at around 4.2% levels. So, what will be the main, because what it appears from the system that there is a lot of pressure on the cost of deposit, in the sense that doesn't seem to be reducing. And even on the yield side, like if we hear the commentary of other banks, they're not very sure of the growth there. So what is it that is going to help us to keep our NIM stable at 4.2% for this year, particularly considering the hardness of the rates across? And then I'll follow up with other questions. Yeah.
The thing is that firstly, as the Pritesh has just discussed about the cost of deposit, there are statistically around 1,600 crore of the term deposits are getting due for repricing in Q2, which was going to give us some benefit of around 10 basic points to 12 basic points on that particular portfolio, which is around statistically it is around full 1,597 odd crore rupees. So I'm not taking the advantage of that. I believe that particular benefit will be taken away by the increasing cost of deposit. So that's why when I asked the first question answer, that particular thing will be counter-adjusting each other. So there is some benefit which we are expecting from the existing deposit which is getting repriced versus the incremental deposit at the incremental price. So which will be counter-adjusting each other. So the benefit will be adjusting each other. So the net benefit will be stable. So we'll be seeing a stability in there. On as far as the yield is concerned, yield we are already being optimized. The yield has already been reduced towards 10.9 from 11.1 last year. So just there may be some minor up and down on the yield side. And now if any interest rate movement comes, that will be affecting both the side of the balance sheet. Now we are not seeing any downward interest rate movement, which will not be able to pass through the deposit. And on the upward interest rate movement, Capital Bank balance sheet is very, very well positioned. So that the benefit on the deposit will not be accruing immediately for the whole portion, but only for the incremental, whereas benefit will be coming from the advance side. So that giving us a comfort that for the remaining part of the current year, we will be able to maintain the NIM and start looking forward for the NIM expansion in FY28 and 29. Given the average CD ratio will also increase. We are presently reporting an average CD ratio of 83%. And as we discussed over the last couple of calls, we intend to take it to the mid to high 80s. So there is a sufficient opportunity available for the average CD ratio expansion, which will be adding to the NIM expansion as we move forward in the coming years.
Sir, but our, most of our book is fixed rate, right? About half of our book is fixed rate.
Sorry to interrupt. Mr. Aditya, we cannot hear you well. Could you use a microphone while asking a question?
Yeah, I'm on the microphone. Sir, am I audible now?
Yes, Aditya, now audible.
Yeah, sir, so what I was saying is that
Aditya, the voice is getting missed. To the extent I understand, you are talking about the fixed versus floating composition of the book.
Yes,
If I talk about today, we have a 50% fixed rate and 50% floating rate advance book. So we have a very fair portion of a floating rate advance book, so which will be giving us a benefit. So if we talk about, which is giving us a comfort to maintenance of the NIM as we move forward.
And so the floating, I think most of it was MCLR linked.
Sorry to interrupt, Mr. Mundra. We are not able to hear you well.
Okay, let me fall back in the view.
Thank you. The next question is from the line of Sagar Shah from Spark PWM. Please go ahead.
Yeah. Good morning, management, and thank you for the opportunity. And congratulations to the company for posting such good numbers, actually. Now my first question was, sir, was regarding to our NIM expansion. So I wanted to understand as far as consumption and other loans is concerned, when we talk of auto loans, gold loans, where the yield is more or less stable, but do you see that at least the share of these loans going up as you move to newer states? That is my first question related to, and related to related to the entire gross loan portfolio. What will be the mix that we are eyeing by FY 2028 and 29 that will actually enable higher NIMs for you in the future?
If we talk about the deposit advance mix, and if I start firstly with your question of the consumption, let me clarify, Sagar ji. Consumption loans are typically a second hook. These are not the start point. These are the additional loans which my existing borrower, may it be a business loan guy, may it be a mortgage loan guy, or maybe many other customer who take the additional loans. So which is constituting almost 7% for a long period now. So our consumption loan is stable at around 7% for a long period. And if we talk further slice of this, within the 7%, the around 2 to 3% always remain the loan against deposit or loan against securities, which are typically with a very limited interest yield opportunity available. So consumption loans are always a top-up loan for us. So the composition of the consumption loan as a top-up loan almost remain constant across the geographies wherever we go, whether it is a Punjab, out of Punjab, or that particular way. So that is the point number one. Point number two, if I talk about the mix which we see going forward, we being a lender who typically look forward for a production lending, that is the money which we give shall be used for the generating a cash flow for the customer or meeting his housing need. So the three portfolio which our target cost portfolio are the business loan, agriculture, and the mortgage. These three things put together typically constituting anything between 75% to 82%. So we continue to believe that will continue to remain in the similar numbers, but I seeing a good momentum which is building up in the business loan segment. But in the coming period, I see a good momentum will be coming also in the LAP. So even if you look into the current quarter, our LAP portfolio, which is also a good yielding portfolio, which is around 12.27% portfolio level yield, is growing by 5% quarter on quarter and 18% year on year. So that is another portfolio which we seeing getting a good traction. Within the mortgage, our overall growth is not that strong, not equal to the overall growth because of the housing loan, which we have also start getting back into the action. And the current quarter, we grow it by 3% quarter on quarter, and year on year it is grown by 10%, given the pricing competition from the PSB space is getting some muted. So with that thing in sight, we're seeing a good traction coming up from all the segments, and by ensuring us that we are maintaining a suitable mix, which is growth oriented and also which is oriented towards maintaining the level of the interest spread, which we target as a difference between cost of deposit and yield on advances. So which we're targeting to keep it around 5.05 or 5.1 to 5.3. So which we for the coming next 1 year or so, which is giving us this confidence that we can able to do so with this matrix. And even if you look into our business loan portfolio, our overall yield is now 10.5. Despite the fact our cost of deposit has reduced by 15 to 20 basic points, the decline is almost negligible. It is almost stable at what we were in the quarter back. So that's the overall portfolio mix and portfolio outlook, what we look forward as we move forward.
Thank you, sir, for such an elaborated answer. My second question was related to actually our NIMs is concerned. You have highlighted that there will be some expansion on NIMs due to the CD ratio going up. So sorry I missed out, but what is the CD ratio that we are eyeing, sir, in FY27 and FY28?
If I talk about the NIM we able to improve in the Q1 towards 4.21, and the primary driver of the NIM was deposit repricing coupled with the acceleration in the CD ratio. For the remaining year 2027, we intend to maintain or slightly improve maybe there, but almost maintaining it around 4.2% level. That is the one variable we are very closely monitoring. And then we will be looking for accelerating it in FY28 and further accelerating in FY29. Our average CD ratio in Q1 FY27 is 83%. If I talk about the average CD ratio here, I means the daily average CD ratio, that is the average of the daily average of the advances and the daily average of the deposit. We intend to take our average CD ratio in mid to high 80s. So there is an opportunity available to accelerate it by around 3 to 6%. So that is the one opportunity which will be available for the NIM expansion, because that means assets which are presently sitting in either the investments or the interbank placements will move to the advances, and the thing which they are carrying at around 7.5% will move towards 11% carry. So which will be helping us in improving the NIM as we move forward in the coming years. So that I was trying to mean by this particular thing, Sagar, which I said earlier.
Okay. So basically, the money that is sitting in investments and cash, that will be routed for the new states that you are eyeing, right? Especially for MSME loans.
Yes, I will say so. I will not say that money. I am saying the composition, because the balance sheet.
Yes, absolutely.
The composition of the balance sheet will be moving. That money will be moving instead of sitting at 7.5% carry. That will be moving towards the 10.5 to 11% carry.
Okay. Got it. Right. Thank you so much and all the best.
Thank you, Sagar.
Thank you. The next question is from the line of Parth Gutka from 361 Capital. Please go ahead.
Yeah. Hi, sir. Thanks a lot for the opportunity. Sir, on the earlier participant's response, you mentioned that, the competition from PSU banks in the pure home loan segment is, slightly come down. Now, is it because, is it because of the rates, or is it because of the ticket size, or is it because of the geography? Can you give some color on that front?
So typically, if we look into the last year, FY26, with a sudden sharp decline in the repo or the packing rate at ABR, where the benefit of that particular thing has not been fully transmitted to the deposit side, which restricted us or giving us a limited opportunity to lend to the housing loan, which is completely packed with the EBR, and accordingly the price has substantially reduced. Now, current year, the cost of deposit has reduced with the repricing coded, with the deposit which we have accepted in 2025 or 2026 first quarter, being the deposit typically accepted in the 400 days to 500 days average maturity. So our majority of the deposit will be getting repriced, or I will say 90% plus of the deposit will be getting repriced by the Q2. So which will be giving us in a level playing field from that particular regard. So accordingly, which is giving increasing our strength to increase our proportion of the housing loan. Point one. Point number two, what happened? We being in a Shuru specific play, we have a 74% of the branches in a semi-urban and rural segment. We are a middle income group play, that is the segment which is which is the annual income earning of the gentleman from 6 lakhs to 40 lakhs. And where the housing loan, which if we talk about the over housing loan segment, that is a segment which is typically 20 lakhs to 25 lakhs average housing loan ticket. So in that particular ticket, so we start getting a good competitive strength given our deposit repricing poured in and some sort of intensity of that competition in the Shuru segment getting reduced. So which help us. I will not say that is completely being done. Some portion is still to be left. So that's why I will not see a very, very strong growth in housing. I will see a better growth in LAP and the business. But still, instead of not growing, we will be start growing in the housing loan, and which we did also in Q1. We grow housing loan by 3%, which we were not able to grow for 1 or 2 quarters. So that is what I'm trying to say here, that housing loan has also started contributing towards the growth momentum and without affecting the yield. If we look into the yield curve of the housing loan, Q1 we closed at 9.87, which was Q4 FY26 9.85. So we are able to increase the portfolio by maintaining or slightly increasing the yield curve. So this is the perspective I'd like to put forth on my side.
Okay, sir. My follow-up on that is, how is the competition from the private banks, or when I say private, large private banks, in the mortgage segment and the MSME segment? Yeah, sir. That's my last question. Thanks a lot for the elaborate answers.
First of all, we being a middle income group segment, our biggest competitive landscape is typically from the PSB space. And if I talk about the business loan segment, which we being targeting tier 2, tier 1 and tier 3 towns, in which typically the business guy whose top line is typically anything between 1 crore rupees to 25 crores to 30 odd crore rupees, which is giving us a collateralization. So, and who are domestic consumption led. So that is our target segment. So the competition intensity and our biggest play is in the ticket size of 10 lakh rupees to 50 lakh rupees. That is our largest play in the MSME segment, which is pushing us up. So in this particular space, if we look into my universal commercial bank, private sector universal commercial bank brothers, they are targeting it, but not very, very strongly targeting. Their strong target is always above 1 crore rupees of an average ticket. Whereas our target is typically 10 lakh rupees to 50 lakhs or maybe 10 lakh rupees to 75 lakhs. So the competitive strategies out there are working in the favor. And if I talk about from my PSB brothers, given the service, if we talk about the consistency of the service between the urban, metro and the semi-urban, where we are able to have a plus over my PSB brothers. And given the pricing, we are not charging something extraordinary. We are charging slightly above the market with our service, which we are able to capture with our turnaround times. So that is being reflecting in our growth also. If you look into our business loan, which typically grow 49% on year-on-year and 11% quarter-on-quarter, and we are continuously improving it from last now 6 quarters. Every 6 quarters, you will see our business loan is growing at a much, much faster pace, which is giving us a good confidence and trust that with our service approach, with our experience, I will say it is not just the pricing, it is the overall experience. What is the turnaround time, how we behave with him, how we are transacting him. So all these things put together, and with the one good customer's approach, we keep on getting a multiple more customers, which is now giving us a multiplier effect. So with that thing inside, we are seeing a good traction, both in the LAP market as well as in the business loan market, which are slightly linked because these two customers have some connection togetherly. So, which is giving us good confidence, and from a competitive landscape also, we are well positioned. Now our cost of deposit being 5.6, our OPEX is 2.95 types. So, which is giving us enough opportunity, enough strength to be in the market at the right price.
Sure, sir. Thanks a lot for the elaborate answer.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Nilanjan Karfa from TCG AMC. Please go ahead.
Hello, sir. Good morning. I hope I am audible.
Yeah, you are audible.
I just want the first question is, I don't know if you have addressed this question in the past, but could you talk about your agri loans? And why do they have a yield which is higher than every other segment?
So agri as a product, as in the industry level, is carrying the yield which is around the level we are targeting. Let me give you some color. Firstly, what we do in agri, we are doing an agri where the farmer needs the lending anything between 5 lakh rupees to 35 lakhs. So our target segment is purely the segment of the farmer whose financial need or the borrowing need is 5 lakhs to 35 lakhs. In turn, we are not a lender to the small and the marginal lender farmer, and neither we are a lender to the large farmer. So our target segment is the farmer whose need is 5 lakhs to 35 lakhs, and our average ticket size of this particular portfolio is 30 lakhs. And we are not in sub 5 lakhs lending. So, and which is giving us a good resilience also and giving safety cushion also. In the segment which we are targeting, 5 lakhs to 25 lakh segment, the PSB market is also around 12 basis. So we are typically charging 25 basic points or 35 basic points given over servicing from each of the segment, and that's true also in agri. So that's the way the agriculture is getting fetched at this price, and this is consistent. If you look into any of the year's number, I talk about the last 7, 8 or 9 quarter, you will find it is to be 12 to 12 and a half. So that is the range which we are maintaining for a long while now.
No, that is fair. I have looked at the past numbers also. I'm just wanting to figure out what type of loan is this that the yield is higher, which means, typically higher yield will mean a higher risk. So I'm coming from that point. What type of loan is this that, whoever it is, whether it is you or PSP Bank, that they are charging such a high yield? What is the risk in this?
Typically, agriculture loan, what we are doing this particular loan to the farmer for his farming need. That is the loan which is required by the farmer for the cultivation of or for the sowing of the crops, or for the crop purpose, or for the investment needs for that relating to that particular crop. Here, what we do for the risk mitigation, point number 1, we are a lender to the farmer who is a middle income group farmer. That is, who is not potential to any political challenges. That is which we call look forward for the Indian domain up to 3 lakh ticket. Point number 2, we are lending to a farmer who is a progressive farmer, that who is cultivating ideally 3 crops in a year, but minimum 2 crops in a year, so that any type of challenge in single crop is not resulting in a significant gap. Point number 3, we are lending to a farmer who must be growing minimum 1 MSP crop, but ideally 2 MSP crop, so that with a higher productivity, price fluctuation risk doesn't come. Point number 4, the agriculture loan, whole of the agriculture loan which we lend is with the collateralization of LTV of 50%. So that is what we do on this regard. So the pricing is basis the various inbound risk attached with this particular portfolio. So this particular portfolio is being perceived as the risk because of the climatical regions or that type of regions. So that's the reason this particular portfolio is fetching around 1.5% more than the overall other portfolio yields.
It's not for us, it is for industry level. Your question was also similar, because why the industry level the yields are high on agriculture? Because of these risks which they perceive this, so this product gets priced industry-wise like this, and we are a part of that.
And then again, I just draw your attention to page number 11 of our presentation, in which we try to demonstrate over last 10 to 12 years of our historical trend lines of our gross and net slippages along with the credit cost, along with the major events happened on those periods, may it be natural calamical, economic or socio-political. So that gives you a fine how position now we are.
Fair point. Thanks for that. Just a additional clarification, the SMA 1 and 2, it is for the entire portfolio, right?
Yes, it is for the entire portfolio.
Okay. And maybe, maybe not now if the answer is becoming too long, but could you talk about how you are, attracting loans in Haryana? Is the model anything different out there?
We as an organization are doing the business through a branch-led model. What I mean by this? Which we typically do the carpeting of the branch. Wherever we go, we have a very strong branch presence. So our majority of the acquisition is through our sales team, who are typically called our personal banker, relationship manager, or the business development officers, or the ARMs at the branch level, who are typically sourcing the business from that particular geography, which is reviewed by a different set of person who we call the customer credit head, whose line of control is around 5 to 6 branches, so that we can keep a control on the quality of that particular portfolio, and which is underwritten by a very different person who is a credit manager. So typically our acquisition model is a branch-led model. We strongly believe we need to know our customer well before we underwrite it. So that is the model which we are following not only in Punjab, not only in Haryana, throughout, wherever we are. And we are seeing a lot of merits in this particular model and a good growth momentum along with a good quality momentum as we move forward.
Thank you so much, sir, for the answer. Wish you luck.
Thank you. Thank you, Nilagin.
Thank you. The next question is from the line of Divyansh Gupta from Latent PMS. Please go ahead.
Hello.
Yeah.
Hi, I'm
Hi,
audible.
Divyansh.
Hi,
Yeah,
Manish.
Divyansh, you are audible.
So the first question is, sir, that if I look at the MSME asset quality, right, and either quarter-on-quarter or even over a longer period of time, the NNPA has, let's say, been reducing continuously. Now, there is also a base effect of high growth in the AUM of the MSME loans. So I wanted to understand what would be, let's say, an asset quality trend for the MSME loans, X of, let's say, the denominator effect of a high growth in the MSME loan book. And the second part question to it is that the government had launched this MSME scheme for the credit scheme for MSME customers. Do our customers qualify, or all our customer segments are excluded right now?
As far as I take the question one by one. First of question, as far as the net NPA or the gross NPA position on this particular segment, you believe that it is because of the denominator factor. If it gives you the color about it, over gross NPA number of the business loan segment, the gross NPA of the business loan segment overall, a value basis, what was there on 31st of March 2023, and the gross NPA as on date of that particular portfolio on value basis has been reduced. So our gross NPA on this particular portfolio in MSME was 65.41 crore rupees and 31st of March 2023. And if I talk about the gross NPA in MSME portfolio as on June 30, 2026, it is 54.54 crores. So we are able to do a decent share of recoveries and in controlling the accretions. So it is not linked with the base effect. So we are able to see momentum both on the upside growth and also maintaining the quality of the book from the recovery angle. That is the point number one I like to mention. Point number two, if I talk about the ECLGS, yes, we are eligible, our team, our staff, our customers are eligible for ECLGS, and on need to have basis, they are getting that particular support of 20%, which is a government guaranteed also. So we are being part of that particular, passing through that benefit on a deserving cases as they were provided by the government of India. So our team, our staff, our customers are eligible of 20% of the working capital facility.
Understood. Understood. And so just for data clarification, that 65.4 coming to 54 is the March 23 ka GNPA, right?
Yes, March 23, that's I said, I've given you a very longer period. That over the last 3 years, we are still able to manage it.
Got it. The other question was that how much of our loans gets repriced on an annual basis? The reason being that, let's say till now, even if there was a rate reduction environment, the loans might not have gotten repriced, whereas we got benefit of the deposits repricing. Now, for whatever inflation and anything that happens, how should we understand the impact of these loans which gets reset on an annual basis? Because liabilities will increase, but loans might not.
Let me give you, that's where my perspective, Shah. So now when we talk about the MCLR, current quarter, Capital Bank has increased the MCLR from 9 by 10 basic points. Now, if I talk about the annual reset portfolio, our annual reset portfolio is around 48.67% of our present portfolio. So our 48.67% of the portfolio will automatically get repriced, and out of this primarily it is the MCLR driven. So which is giving us a comfort that our NIM will be maintained.
Got it. Understood. And just one last question if I can ask. The outside Punjab assets and liability percentage, if you can share.
Surely. Outside Punjab assets are 25%. So we have a outside Punjab advances asset of 25%, and out of Punjab liabilities are typically 10%. If I give you the comparative data, this 10%, if I talk about last year June, if I talk about the March, it was around 8%. So it has been improved from 8% to 10%. And out of Punjab, that was around 25%, which was typically in the month of March, it was around 24%.
March, you are saying March 26, right?
March 26, a quarter back. I'm talking about a quarter back.
Understood, sir. Thank you. I'll join back the queue.
Yeah, thank you, Divansh.
Thank you. The next question is from the line of Aditya from Securities Investment Management. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. Sir, in our MSME loans, what would be the share of working capital loans?
If I talk about the MSME, I'm not having a very handy data, but one gives you some color that all the guys into whom we are lending, 90% plus will be availing a working capital facility with us. So we are a heavy on a working capital facility on this. So it will be primarily a working capital driven loans. So, but I'm not having a handy data. But one thing I like to clarify that we are primarily a lender whom we are the full primary lender. We are not intend to be one of the lender, we intend to be the primary lender for the segment. So we intend to have a cash flow visibility of our clients. So despite I'm not having a data, but my gut says there is a decent share of the working capital in this facility. May it be a CC, OD or WCTL.
Like Aditya, I'll just add here, we are...
80% plus. So my team has just fetched the data. They said it is around 80% plus.
Understood, sir. Understood. And sir, you just mentioned that we are generally the primary lender. So you have to understand, generally, what is the product per customer which we would have?
Typically, if I talk about the MSME, I believe you are talking about MSME. Cohort, what we are doing cohort here is, we are looking forward for the first, if I talk about the economic activity wise, we target trader community, whether it's a retail or a wholesale trader. We target manufacturer, whether it's a manufacturer in any of the spaces, or we also target the service industry. May it be providing any other service. Through all the three economic activities within the business loan segment, we target. And if I talk about the top line, we are typically targeting the clients whose typical top line over expected that he should be not a very nano. We are not in a nano business. That is a sub 10 lakh business. We are not in a nano business. We are in a meaningful business. So typically over expiration, that is top line is anything between 1 crore. Or I can say maybe 75 lakhs, maybe we will start it also. But typically targeting it anything between 1 crore rupees to 30 crore rupees. That is the top line in which he is operating in. So these are the two cohorts in which we are operating, and primarily these gentlemen will be in the domestic consumption advice, who are typically dealing with the domestic buyers and domestic sellers. So these are the three cohorts in which we are targeting over business loan segment.
No, so my question was, a particular customer of ours, how many products would we be taking from the bank? Be it a loan, be it a savings account, a current account, or a insurance product?
Aditya, the answer to this is not that simple. Given the lending in the business loan is given in the name of his firm. Typically, it may be a partnership firm, it may be a partnership, proprietorship firm, LLP, or the private limited company or public limited company. Primarily a private limited company. So in the deposits he will be giving us in the name of his individual custodies, and he's taking us the liability businesses, third party businesses in the name of his individual capacities. So if I talk about the relationship management from the custody perspective, that will be completely a different number. But if I talk about the relationship values from that particular family, that will be completely different value. So statistically deriving the number on the family oriented, but I will say we look forward for a multiple hooks with that gentleman. Our objective is when we enter that business loan, we take care of the salary account of his whole of the workers, we take care of the savings of whole of his family, we take care of the protection plan of whole of his family, we look forward for the engagement with his buyers and sellers. That's the way this business is growing. So we are getting the leads from one to another and data from one to another. That's the way we are leading from one customer to another customer. So we are very active in cross-linking and engaging. And that is the way we are able to improve our cost income also and improving our quality of book also.
Understood. Understood. And sir, any outlook on CapEx? Currently it is around 2.95-3%. Going forward, with our expansion strategy, do you believe it would remain at a similar level, or there is scope for some improvement over there?
I see there will be if I talk about, I will slice this question into two time series. If I talk about FY27, I will see some improvement in the OPEX level. We are typically current quarter, we're seeing it around 2.95 to 2.98% levels. That is the OPEX in the current quarter. I am seeing an improvement in the coming period for this. What I make me believe so, because if I talk about my OPEX has primarily the salary component. and in the quarter one, annual increment comes due. So with the first quarter, we have a higher salary against the not the fully optimized business. So which will be getting adjusted over the period when the salary increase will not be there, but the business will keep on increasing. So the OpEx in the quarter one versus OpEx in the Q3 naturally will be different. So we will be seeing a good operational outlook on the OpEx as we move forward in the coming quarter. Secondly, with the scale increase, so the OpEx is going to be looked forward. So in FY27, I will see a moderate increase in the OpEx. But if I talk about my FY28 and 29, I see a big momentum in the OpEx, and that will be contributing to my ROTA expansion also. So my OpEx expansion in FY29 will be a larger play. FY27 and 25, it will not be that larger play. But in FY29, it will be much larger play.
Sure, sir. Thanks for answering my question. I'll join back with it.
Yeah, thank you, Ditya. Thank you, Ditya.
Thank you. The next question is from the line of Aditya Mundra from MyControl. Please go ahead.
Yeah, sir. Am I audible now?
Yes, you are audible, Aditya ji.
Yes. Sir, so what I was asking is, sir, the overall MSME growth, which has been very good this quarter, firstly, what would be the reason? And secondly, sir, how are you seeing the MSME growth as well as the overall growth going forward, especially for FY27?
Aditya, we are confident about our FY27 and FY29 growth outlook, which we have shared over the years, beginning of the year. So we are quite confident. We are given a guidance of 22% current year growth, and we are confident of maintaining that. And we have given a guidance of 16,000 by FY29. So we are confident about both. If I talk about the MSME, MSP is not grown only in this quarter. If you look into our last 3 to 4 consecutive quarters, you will see a traction in the MSME every quarter. So I am confident of MSME growth even in the current quarter. So even if I talk about the running quarter, I will be seeing a good opportunity still in the MSME. There is a good opportunity available in MSME growth, still available. And since I believe after we getting into this particular value chain system, we have one value chain to another to another. So which is building up which is taking a good momentum at the branch level, at the customer ID levels. So I am seeing a good momentum in the business loan segment as well as the overall loan segment. So if I talk about position as on date, it is giving us a good confidence and strong. We are confident of maintaining over both the annual guidance and FY29 guidance.
Sir, the MSME, is it an industry-wide phenomenon that we are seeing across Punjab, Haryana, or is it something that we have taken, some steps that we have taken which have given us this kind of growth? What's your outlook on that?
It is not an industry level data. We have done a lot of different things earlier, as I said earlier. So we have a specific niche. So we worked on that niche. We have specialized trained team now on MSME at the branch, at the cluster levels. We have a very clearly value proposition for the MSMEs. So, and we have a very good, I will say, customer feedback. Customer works on the other customer feedback very, very quickly. So with that customer feedbacks, so these are a lot of stuff. We have worked a lot of stuff on this, including increasing the tag, servicing standards. The business people look forward for a very high servicing standards. So all these things, small things, but a lot of things are there, which is helping us in building it up. So that's what we are intending to do, and also we keep on evolving the product. So whatever is the need of that particular gentleman, minor tweaking. I will not say the major tweaking, minor tweaking. So those minor tweakings so that the friction can get reduced. So all those things put together are increasing this particular momentum, and we are getting meaningful share. And with the strong branch presence, we are being always following up about a thick branch presence wherever we go, and the carpeting approach. So that are also adding to this with the customer references getting very, very seriously activated.
Right. And sir, there is a slight increase on the SMA2 level, although overall it has come down. So any light on that? Overall SMA1 and 2 has come down though.
Yes, that is I will say the Q1 is typically always the period in which the typically SMAs always shoot up. But this time we worked very, very hard and very concentrated that we will not let SMA1 and SMA2 shoot up, and we are able to contest it. But what typically happens, there is always a lag between the farming money reaching to the business peoples or to the other set of the economic, because that money comes to the farmer, then it will transmit it into the other people, and there is always some lag. So that's why in June and December, you will see some SMA position is getting some slightly deteriorated. But with concerted effort, we are able to reduce both overall basis SMA 1 and 2 put together. But yes, there is a slight increase in SMA 2, that is from 2.71% to 3.11. That is typically, I will say, not a meaningful, but we are not keeping it unnoticeable, and we are working very, very hard to bring it further down.
But it's business as usual. There's nothing which is there's nothing out of the ordinary in that, is what you mean.
Yes, that's what I mean. And the numbers are also speaking the same thing. So having a 30 basic points, or we are talking about the basic point change. We are not talking about a 100 basic point change even. We are talking about a basic point change. In the portfolio, basic point change always happens.
Yes, sir. And sir, there is a slight decline on the other income, like non-interest income.
Sorry to interrupt, Mr. Aditya. May we request you return to the question queue for a follow-up?
Sure.
Thank you. The next question is from the line of Siddharth Chandrasekhar, an individual investor. Please go ahead.
Hi, sir. Am I audible?
Yeah, you are audible, Siddharth.
Yeah. Congratulations for the good set of numbers. So, sir, I have one doubt related to our deposit profile, right? So, if I see the last 5 years, deposit growth Q on Q for the Q2 and Q4 is flat for our bank, which is little different for the other banks where like they showed good deposit growth for the Q4, and also Q2 they are showing some decent 2 to 3% some kind of growth, right? So why there is a difference in our bank? Because this is happening for last 5 years, and additional to that, since we are targeting 20 at least based on our FY29 growth, right? So we need to improve our deposit growth. So I see Q1 and Q3 we are always doing good, and this Q1 also we have showed good growth in deposits. So is there any trend change will happen in the upcoming Q2 and Q4 where there also we will show some good growth in deposits so that it will match the loan book?
First of all, Siddharth, I'd like to tell you about our business profile on the deposit. If you look at our slide number 26, you will cite one thing that if you look into the deposit composition, over 75% of our deposits are coming from a semi-urban and rural market. So, and if we talk about the other market participants, you will find a different number. So we are in the ground root level and purely retail, and we are 90% plus of our deposits are retail. We are not a bulk heavy or a bulk dependent liability franchise. We are a purely retail centric deposit franchise. So if you look into these two numbers put together and review it, you will say we are raising money from where the actual money is lying, that is the semi-urban and rural market, and deploying. And on the asset side, you will see 45% of our deployment is in urban and metropolitan. So we are raising the money from a semi-urban and rural and deploying it in an urban market, where the less risk of deployment is there. So that is the overall business model which we are following. Now, since we are predominant presence in Punjab and Haryana being the agri-heavy states, where economic activity directly or indirectly, or even I talk about a lot of linkages between agri crops. So, and these two states, the procurement or the crop harvesting or the crop money is flowing in Q1 and Q3. So we take an opportunity in that particular quarter when the money is coming into the system to grab it as much as we can. So if you look into that particular perspective, you will see in Q1 and Q3, our deposit will be always outpacing our advance growth. If you look into any of the last years, you will see in Q1 as well as in Q3, our deposit growth will be outpacing the advance growth, and in Q2 and Q4, our advance growth will be outpacing our deposit growth. So we are maintaining a fine balance between both the pillars in a different time cuts so that we can get optimal outcomes. So while we completely understand that we are very, very serious about our deposit franchise and deposit growth, so we are a 83% average CD ratio entity. So which is the lowest in the small finance bank space and well comparable with the significantly lower also with a lot of universal commercial banks. So we constantly believe to improve the efficacy ratios, we need to increase this average CD ratio. So our advance should outpace our deposit growth for some years, maybe 2 years or so. So which is the one factor which we are taking care. So yes, we have worked a lot hard. If you look into our, I will say, about a seasonality trend on our asset side. Our asset side now the growth is almost uniform in all the 4 quarters, not exactly uniform, with a lesser deviations, with a higher growth in Q2 and Q4 and with a decent growth in Q1 and Q3. So we are also moving in the same direction on the deposit also. So, but yes, over Q1 and Q3, given the market money coming in, will be heavier on the deposit growth, and Q2 and Q4 will be heavier on the advance growth. And that's the way overall on a year-on basis, you will find a fine balance. And if we talk about FY26, which we have just crossed a quarter back, we grow both over deposits and advances by 21% each. So that's my submission. And still today we are 83% CD ratio with enough opportunity to grow and enough opportunity on the liability side. We are 95% of our outside liabilities are deposits. So a lots of other alternative funding options are available at most competitive pricing. So liabilities not seems to be a point of concern for our growth. So liability is one of our biggest assets. This is what we strongly believe. Liability is one of our strong and biggest asset. So this is what our perspective is about the same, Siddharth.
Yeah, thanks for that, sir. Sir, one more question. Since we are meeting most of the requirements that RBI has stated for universal bank, are we trying to apply for that?
So yes, we are a aspiration for the universal commercial bank, but it all will be done at the most appropriate time. My job as an executive member is to make ourselves eligible for universal commercial bank by making a full diversification and ticking all the boxes. The one box which is left to be ticked is net NPA, and we are working hard from the last 2 quarters by increasing slight PCR towards reaching towards 1% NNPA. So just at the most appropriate time, board, the apex body of us, our board will take a decision. But one thing I like to mention, Siddharth, growing at the present avatar is also very, very strongly available. But just we are aspiration for the next level, and we look forward. Go for the next level in a very strong and a committed way, so that the chances of success are much higher. So we will be going for universal bank, that is for sure, and we are strongly aspiring for that. Just we are looking forward for the appropriate time to time it. Maybe with our looking into some business metrics, what my board has internally decided. So we are working towards that, and at the most appropriate time, we will go for the UCB. That is for sure. We are high aspirant for that particular license.
Yeah, thanks for that answer. That's all from us.
Thank you. Ladies and gentlemen, due to time constraints, we take that as the last question for the day. And now I would like to hand the conference over to the management for closing comments.
Thank you everyone for being part of this call. We hope we have answered your questions. If you need more information, please feel free to contact our investor relation team or SGA, our advisors. Thank you very much once again. Have a great day ahead.
Thank you. On behalf of Capital Small Finance Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.